Hey everyone, welcome to This Explainer. Today we're diving deep into a massive structural shift in how wealth is created in this country. We're going to look exactly at how the historic 2026 tax shakeups have completely rewritten the Australian real estate wealth cheat code. Let's get right into it, because if you're holding property or planning to buy, the rules of the game have fundamentally changed.
You know the old playbook, right? For decades, the ultimate strategy, the widely accepted path to millions, was intentionally buying properties that lost money every single month. I know, it sounds completely backward to an outsider, but in the financial world, this was just the accepted norm. Well, that lazy era is officially over. The days of simply buying an old house, taking a monthly loss, and just waiting for the tax man to save you? Yeah, those days are dead.
And here is the catalyst: 2026. With the massive federal tax reform slamming the door on established properties, the entire investing landscape has violently shifted. This isn't just some minor policy tweak, folks. It's a complete restructuring of what the government will and will not allow you to claim. You really can't just rely on the headlines anymore. You need to understand the underlying mechanics of what this year represents for your portfolio.
So to make sense of this wild new landscape, we're putting negative gearing and positive gearing head-to-head today. These two distinct wealth engines operate very differently under the strict new 2026 rules, and we're going to figure out exactly which one will actually accelerate your path to financial freedom without getting you trapped by the tax office.
Okay, let's start with Section 1, negative gearing and new builds. All right, we all know the drill with the traditional negative gearing model. It's when the cost of owning a property is strictly higher than the rental income it generates. At the end of the day, the asset literally bleeds cash out of your pocket every single month. We're talking about the constant drag of mortgage interest, property management fees, council rates, and of course, the never-ending general maintenance. It all adds up, leaving you firmly in the red.
So, you've got to ask yourself, why on earth would any smart investor deliberately buy a business asset that constantly loses money? Well, it comes down to two massive financial levers: huge tax deductions against their personal job income and explosive long-term capital growth. See, smart investors stomach the short-term cash loss because under Australian law, the tax office allows you to take that rental loss and subtract it from your personal high-income salary. You're basically trading a small cash loss right now for a massive tax refund, all while waiting for the property to skyrocket in value over the next decade.
But wow, here is the brutal 2026 reality that changes absolutely everything. The government has slammed a heavy steel vault door completely shut on this strategy. As of these reforms, negative gearing is strictly banned for older, established houses. You can't just buy a 20-year-old suburban brick home, run it at a loss, and claim those massive tax refunds anymore. That old loophole is officially closed. So, the absolutely crucial point here is this: if you want to use negative gearing to shelter a high income today, you're legally forced to invest exclusively in strictly brand new construction builds or off-the-plan investments. You have to buy new. But as you probably guessed, this strict requirement completely shifts your risk profile. Buying brand new comes with its own unique set of dangers. Everything from builder insolvencies to valuation shortfalls, it forces you to play a much more complex game.
Moving right along to Section 2, positive gearing and regional hubs.
Now, if negative gearing is bleeding cash, positive gearing is catching it. This is when the rental income you collect is actually high enough to cover every single property expense, with net profit left over. That profit flows directly into your bank account every single week. This strategy abandons chasing tax breaks entirely in favor of creating immediate passive income. This isn't about waiting 10 years for the market to double so you can finally sell. No, this extra money goes into your account today. It's essentially the ultimate tool for lifestyle design and early retirement, giving you actual liquid cash to live your life on your terms. And honestly, here is the absolute best part. Banks love positive cash flow. Because the property essentially pays for itself, it actually increases your borrowing capacity, making it infinitely easier to scale your portfolio to your second, third, or even fourth property. It's like an engine that fuels its own expansion rather than dragging your borrowing power down. But, and there's always a catch in finance, right? There's a serious hurdle you must be aware of: higher taxes. Because you're making a net profit, the tax office treats that extra cash as personal income. This means your yearly tax bill will actually go up. It heavily penalizes investors who are already sitting in a top marginal tax bracket. You're making more money, sure, but you're also handing a larger chunk of it right back to the government. The tax man always gets his cut. So where do you actually find these properties?
Well, to snag these high-yield, positively geared assets today, you generally have to look outside the major capital cities. You must aggressively target booming regional hubs. These areas often offer the perfect storm, significantly lower purchase prices to get your foot in the door, paired with incredibly high rental demand from a growing local workforce. Let's ground this in today's economic reality for a second. With the RBA cash rate locked firmly around 4.35%, protecting your liquid cash flow has literally never been more critical. In a high-rate environment, holding debt is incredibly expensive, so that positive income stream, it isn't just a nice bonus anymore. It's an absolute lifeline.
Which brings us to Section 3, the ultimate hybrid strategy.
So, how do elite investors choose between these two opposing forces in a post-2026 world? It basically comes down to a direct strategic match, aligning your current salary with your goals. High-income earners paying way too much tax, they need new builds for that negative gearing tax shelter. But if your goal is to quit your 9-to-5 and replace your salary as quickly as possible, you need regional positive cash flow.
But here's what the most sophisticated investors actually do. They synthesize both over their lifetime. During their peak earning years, usually ages 30 to 50, they use negative gearing on new builds to completely crush their massive tax bill while building a high-growth asset base. Then, as they approach retirement and their active income naturally drops, they pivot heavily into positively geared assets. This careful sequencing creates the ultimate final stage, a self-sustaining financial ecosystem that pays for their lifestyle forever.
Look, the reality is this. The 2026 rule changes haven't destroyed property investing, they just destroyed the lazy investors. They simply demand that you're smarter and more strategic. You have to understand the numbers, speak directly to your accountant about how these new structures affect your specific tax bracket, and most importantly, execute your strategy without emotion. Don't let the scary headlines push you out of the market. Just adapt to the new rules.
Thanks for joining me for this explainer. As we wrap up, I want you to really analyze your position, make your move, and ask yourself a crucial question. Under these strict new 2026 rules, which strategy will you use to build your ultimate self-sustaining ecosystem? Are you hunting for new builds to shelter your wealth, or targeting regional hubs to buy your freedom today?